And Mattie, I noticed is looking at, newspaper ads for CDs of 2.5%, 3%, depending on how long, you want it there, and that's protected. That's money that isn't put at risk in the market. I don't know what the inflection point is, at which point normal equity investors say, you know what, given this craziness, I'd rather be in something low yielding, but at least safe, than high yielding and all of a sudden gone. And I'm wondering if that comes back to boomerang the White House. What do you think?
Yeah, in some sense, it's a question of whether or not the market forces and the political realities on the ground intercede one another or are at a disconnect. Now, I'm looking at two things this next month. One in particular is on trade. Before the election, we were talking a lot about the new NAFTA deal, USMCA. Can it get done after the election? I want to see Democrats actually start to put some plans forward and talk about how they feel about trade. Because the president has been so vocal about NAFTA, Democrats have not had to answer the question of how they feel about negotiating the agreement. Now they're going to actually take a vote into the coming year.
More than Republicans do, right? Wasn't that the irony that it was kind of ceded to their wishes, right?
Yeah, Neil, I think it remains to be seen. Now, to be fair, in the New Deal, there's not a ton that's different from the old NAFTA. What the most important thing about the New Deal is finding some certainty so we can continue to build on liberalizing our trade practices here in the United States. That obviously will offer a boost to markets. And of course, in the coming year, the first of the year, we've got Chinese tariffs that are slated to rise. There's a lot of trade volatility that, of course, the market is paying attention to that Americans maybe necessarily haven't quite felt yet. But I think that pressure will become much more acute as we head into the new year. And Democrats, as the new leadership in the House, are going to have an answer to respond to that pressure.
Caleb, I'm
Neil,
looking.
can I play?
Go ahead.
Can I play devil's advocate, please?
Absolutely.
I disagree respectfully with the points being made. I think the market is fearful of the administration's hardliners, led by Peter Navarro, who, in my judgment, is economically illiterate. He believes basically in the notion. That imports and U.S. GDP are inversely related. In fact, they're directly related, and the market is seriously perturbed about this hardline policy.
So
I seriously agree with you there.
He's the trade negotiator for the White House. Has a very hardline approach with the Chinese, et cetera. Let me ask you a little bit about that, Caitlin, finally. Is it your sense that if the deal isn't scored, I mean, there's no progress made at the upcoming G20 meeting where Xi Jinping, the Chinese leader, and President Trump are going to sit down and talk, presumably, about this trade-off, and they don't make any progress. Neither side blinks, that this is going to get much, much worse.
It almost has to, doesn't it? I think we have these giant outstanding economic questions in the form of these tariffs and this escalating trade war that's happening. And the goal of the tariffs is to get a deal. But if neither leader caves and cuts some kind of deal, I mean, this is going to have big consequences on our economy. And eventually politicians are going to have to start figuring out, I agree with the points being made about how they feel about it. And it's Democrats, they're going to have a policy response and a position on it. Republicans are too. It's their president that is putting forth these tariff policies that are in direct opposition to free trade ideals. So I think that if there's no progress made on the China front and the trade front with all these other countries, this issue is just going to become more prominent.
Yeah, and pound Doug's point here, I think by now Peter Navarro and others in the administration thought the Chinese would have long ago blinked. I might be oversimplifying it, Doug, but the fact that they haven't and that they're not inclined
Neil,
change.
It's a difference between a trader and a long-term investor. Donald Trump is a trader in the case of Chinese tariff and trade negotiations. China, by contrast, is a long-term investor. I think that when we have an administration, whether you agree or disagree, that is breaking down the post-World War II trade order, this has potentially adverse growth implications as well as social implications.
Well, the administration is going to come back and say, Doug, they started it.
Well, we live, as Tom Friedman says, in a flat and interconnected world. So we have to be very fragile in terms of Twitter-based policy, which is inflated with politics.
Neil, can I make one more point?
Yes, quickly.
Quickly, heading into midterms months ago, Republicans were really worried that this would be a sleeper issue, that the economy would go south after all these tariffs, and that it would backfire. So I would say this is still an issue going into 2020.
All right. you know, Doug, I'm looking at this. I'd like to extend this because it's a very good discussion as we're at session lows and down about 500. And Doug, one of the things you always hear from market players is that the market doesn't wear, you know, political colors here. That, you know, as I've kind of paraphrased here, not red or blue, but green. They like making money. And lately, they've had a tougher time making money as we, you know, fall over 500 points on the Dow, on the belief that the run-up is just sort of sputtering. Now, every time you assume that, though, you know, people come back in and buy, or this might be exaggerated by the fact the bond market's closed today, and there's a short-lived sort of a rise here. Do you see that happening, or is this something more systemic going on?
I would say, Neil, that I generally agree that markets are agnostic to politics. But I would say, as it relates today to today's poor action with the Dow down 508 points, it has less to do with the bond market being closed and a quiet day, and more to do with Friday's announcement that we are seeing nascent signs of stagflation. And as you know, stagflation is one of the most pernicious and market unfriendly constituents we can possibly have.
Well, it destroyed Jimmy Carter. It destroyed Jimmy Carter, and of course we can remember very well the effect. At least you and I can. The other two ladies here.
Sure. Well, the PPI was up. The PPI specifically was up 0.6%.
No, you're right. The wholesale inflation report that some say could be mirrored in the retail inflation report. If he's right about that, Mattie, that is that there are other factors at play. Mm-hmm. You can read into the Apple report. This is just me reading into it, and without any of the smarts of the Doug Kass. But I'm looking at the Apple report. I'm wondering if it is true that their demand isn't as robust for their phones across the globe as was earlier thought. And remember, there are always robust, unique expectations built into anything Apple. That could presage a consumer retrenching a little bit, and that is something up to now very few have really envisioned, and that could be a problem, well, for both parties. What do you think?
For sure. And I think that we need to remember that we are at a time right now where our financial markets and our political realities are becoming so much more complex. And I think that there's a little bit of a disease that we're trying to read too much into one or the other. But I think this is a perfect example of where we've had a market that has been dominated by one sector, that's the tech sector, and it's really been able to drive a lot of growth. So when that story starts to become unraveled a little bit, we have a lot of market observers asking where it comes from. Does it come from market fundamentals deteriorating? Does it come from a specific stock and the fact that we are just overbought into a specific industry? Or does it come from geopolitical pressures? I would argue right now we're at the cusp of trying to explore all three of those reasons. And certainly because we have so much volatility when it comes to our trade pressures, that casts a pale over the rest of the market activity that we're observing right now. So it used to be that we could take one of these indicators, we could take a growth in one company and see that as an indicator for optimism moving forward. And I simply don't think that it's that clear cut anymore. Certainly the policy that comes out of the United States Congress. Yeah, I think it's certainly the policy that comes out of the United States Congress drives that, but we have to be aware of the environmental factors and how they can change. It's the United States policymakers' responsibility to adapt and change with them.
Doug, what was your
Neil,
point
this is a very important point that never before in history, at least the 4 decades that I've been investing, have there been such a plethora of possible economic, political, geopolitical, social, and policy outcomes, many of them adverse. And getting back to Friedman, living in an interconnected and flat world, we have these dominoes, and everything is related to each other. The dominoes are different today than they were yesterday, and different yesterday than the day before. But they're all interrelated, and your guest made a wonderful point.